June 14, 2005, a day when the bell at the flagship Neiman Marcus store on Fifth Avenue rang louder than any other, signaling a record-breaking $4.6 billion holiday season that seemed to cement the company's place as the crown jewel of American luxury retail. Yet, beneath the glittering displays of silk gowns and diamond watches, a silent tide of debt was swelling, inch by relentless inch, toward a $5 billion abyss that would, by 2020, threaten to drag the storied name under. Founded in 1907 by Herbert and Carrie Marcus in a modest Dallas storefront, Neiman Marcus began as a modest haberdashery serving the city's elite. The founder's mantra, "We will sell the best in the world and we will be the best in the world," became a self-fulfilling prophecy. By the 1930s, the brand had introduced its first catalog, the Neiman Marcus Christmas Book, a lavish compendium of rare furs, couture gowns, and exotic automobiles that turned shopping into a spectacle. The catalog's reputation for impossible gifts, such as a 1959 trip to the moon, etched the company into the cultural imagination as a purveyor of the unattainable. The post-World War Roman II boom catapulted Neiman Marcus into a new era of expansion. In the 1960s, the chain opened its first out-of-state store in Houston, followed by a bold leap onto the national stage in 1970 with a boutique in New York City. The 1980s brought an aggressive diversification strategy: the acquisition of luxury department store Holt Renfrew in Canada, a partnership with the online fashion giant Net-a-Porter, and the launch of the in-store art gallery, where emerging artists displayed works alongside designer handbags. Revenues surged, and the company's market valuation crossed the $3 billion threshold, positioning it as a beacon for investors hungry for the high-margin world of luxury goods. But the very ambition that fueled its ascent also sowed the seeds of its downfall. By the late 1990s, Neiman Marcus was leveraging heavily to fund a rapid rollout of stores across the Sun Belt, betting that a burgeoning affluent class would sustain its appetite for extravagance. The company's balance sheet began to show the first cracks: a debt-to-equity ratio that hovered above 2.5, and a cash conversion cycle that stretched beyond industry norms. Executives brushed off concerns, citing strategic capital deployment and the belief that the brand's cachet could weather any market fluctuation. The first warning signs emerged in the early 2000s. The 2001 recession slashed discretionary spending, and Neiman Marcus reported a 12% dip in same-store sales. In response, the leadership doubled down, launching an aggressive luxury for the masses campaign that introduced lower-priced designer collaborations. While the move temporarily buoyed foot traffic, it diluted the brand's exclusivity, a core value that had justified premium pricing for decades. Analysts began to note a widening spread between the company's gross margin and that of its high-end peers, a red flag that the cost of financing was eroding profitability. The 2008 financial crisis intensified the pressure. Credit markets froze, and Neiman Marcus found itself unable to refinance a $1.8 billion tranche of high-interest junk bonds that had financed its expansion. The company's stock plummeted from $75 per share in early 2008 to under $20 by the end of the year. In a desperate bid to stay afloat, the board approved a $500 million revolving credit line backed by its real estate assets, a move that provided temporary liquidity but further encumbered the balance sheet with collateralized debt. By 2014, the company's debt load had ballooned to $4.3 billion, a figure that dwarfed its annual earnings before interest, taxes, depreciation, and amortization (EBITDA) of $600 million. Credit rating agencies downgraded Neiman Marcus to junk status, and the cost of borrowing surged to double-digit percentages. Internally, the culture shifted from visionary to defensive. Store openings stalled, and the once lavish marketing budget was slashed. Yet the leadership remained optimistic, insisting that the luxury experience would eventually reassert its dominance as the global economy recovered. The final domino fell in early 2020. The COVID-19 pandemic forced the abrupt closure of all physical retail locations for months, stripping Neiman Marcus of its primary revenue engine. E-commerce, which had accounted for a modest 15% of sales before the crisis, could not compensate for the sudden loss of in-store purchases, where high-ticket items are traditionally sold. Simultaneously, the company's debt obligations continued unabated. In March, the firm missed a $250 million interest payment, triggering cross-default provisions that threatened to accelerate the repayment of the entire $5 billion debt portfolio. Facing mounting pressure from creditors, Neiman Marcus entered Chapter 11 bankruptcy protection in May 2020. The filing revealed a stark picture: $5.1 billion in total liabilities, $1.2 billion in cash and cash equivalents, and a dwindling inventory of unsold luxury goods that were rapidly losing value. The court approved a restructuring plan that required the sale of the company's iconic flagship stores in Dallas and New York to a consortium of private equity firms, while the remaining assets were merged into a newly formed entity owned by existing lenders. The historic Neiman Marcus Christmas book ceased publication, and many longtime employees were laid off as the new owners sought to streamline operations. The aftermath of the collapse sent ripples through the luxury retail sector. Competitors such as Saks Fifth Avenue and Bloomingdale's seized the opportunity to acquire former Neiman Marcus locations, expanding their own footprints. The bankruptcy also sparked a broader conversation about the viability of traditional department stores in an increasingly digital marketplace. Subscribe to The Collapse for more stories like this.